The shift didn't begin with a crash. It began with silence. On a Tuesday morning in offices around the world, there was no emergency meeting, no flashing headlines, no alarms on trading floors, just a routine liquidity operation, one that was supposed to be routine, insignificant, almost invisible, except it wasn't. That day, a decades-old monetary rule quietly stopped working. No one announced it, no one called attention to it. By the time the public noticed anything unusual, the system had already adjusted. It had already moved on without them. And that is exactly how transitions like this always happen. For decades, the global financial system followed predictable rhythms. Stress appeared in the markets, and the response was always the same. Inject liquidity, calm the system, restore confidence. In 2008, that pattern worked. During the 2020 pandemic crash, it worked again. Every time the system faltered, a swift injection of capital would stabilize it. Volatility would settle. Confidence would return. The equation was simple. Liquidity equals stability until recently. Now, liquidity flows, but stability doesn't follow. Bonds rise when they should fall. Currencies swing without apparent triggers. Capital moves sideways rather than outward. That's not randomness. That's a sign that the plumbing of the financial system is being rerouted behind the scenes. To understand what's happening, we need to look at history. In the late 1960s, the US dollar faced a similar silent crisis. On paper, the dollar appeared stable. Unofficially, foreign governments were exchanging dollars for gold faster than expected. Confidence was bleeding out. The system didn't collapse immediately. It eroded quietly. And in 1971, the Nixon administration ended the gold standard almost overnight. The public only learned after the decision was irreversible. History does not repeat itself exactly, but it rhymes. And today, the rhyme is unmistakable. Data reveals the fracture. From 2009 through 2020, liquidity expansions reliably produced stability. Asset prices rose. Volatility stayed contained. Confidence followed the money. But around 2022, the relationship broke. More money stopped producing the stability it had once guaranteed. The rules that had underpinned financial confidence for decades were quietly failing. This isn't a policy error. It's not a mistake. It's a signal that the mechanism itself is being replaced. At first, many institutions dismissed it as a temporary distortion, a lag, or a statistical quirk. Then explanations stopped entirely. Quiet adjustments began appearing. New liquidity facilities, new settlement windows, revised collateral rules, all implemented without press conferences, without urgency, without notice. Systems that are confident in themselves explain. Systems that are cornered rewire. And that is where the story gets uncomfortable. The shift is not about inflation headlines. It is not about interest rate debates or bond auctions. Those are surface-level distractions. The real change is happening one layer below, where money moves before the public ever sees it. Settlement cycles are being shortened. Counterparty risk is being isolated. Cross-border liquidity is being ring-fenced. Temporary measures never disappear. They become permanent. Emergency rules quietly turn into standard procedure. These are not defensive tweaks. They are preparations. Because when trust erodes, speed becomes control. So why isn't anyone panicking? Panic only occurs when the public is involved. Institutions don't panic. They reposition. They adapt. And right now, their positioning tells a story that press releases never will. Long-term commitments are shrinking. Short-term instruments are multiplying. Flexibility is valued more than yield. That isn't optimism. That is exit readiness. The shift is not coming. It has already started. The moment old interventions stopped working, the outcome was set. Not through collapse, but through transition. The public always experiences these changes last. Every major monetary transition follows a familiar script. First, anomalies appear that no one can fully explain. Then institutions adjust quietly without creating a narrative. Finally, a reframing event arrives, making the new system feel inevitable. Consider the gold standard. Bretton Woods, fiat currency dominance. None ended with sirens. None came with warnings. They ended with a sentence. The new system never arrives all at once. It seeps in gradually, invisibly, through temporary facilities that never leave, through emergency rules that quietly become permanent. By the time the system is named and codified, participation is no longer optional. And here is the question no one is asking. If the system still works, why are so many parts being bypassed? Why are safeguards being built where trust used to sit? Why do every fix and adjustment feel less like repair and more like insulation? This is not a collapse story. Collapse is loud. It screams. It is visible. It produces panic. This is a handover. Handovers are quiet, efficient, strategic. They happen in advance, while the old narrative is still being repeated out loud. By the time certainty returns, it won't be about what changed. It will be about who noticed early enough to understand that it was never a question of if, only when. To understand why this matters, consider the mechanics of liquidity. In a healthy system, when stress appears, capital moves toward safety. Bonds rise, yields fall. Currency flows follow predictable patterns. Risk is measured and compensated. But when the system is being rewired, these rules stop working. The expected responses fail. Capital moves sideways, unpredictably. Volatility spikes without cause. Risk is quarantined rather than absorbed. The old instruments, once reliable, no longer transmit signals the way they used to. This is precisely what is happening today. Bond markets are behaving as if the traditional link between supply, demand, and yield has broken. Currency markets are volatile without news events. Even the flow of capital between countries is being rerouted quietly. Temporary emergency measures, introduced to stabilize markets in past crises, are now being normalized. They are becoming permanent features of the financial landscape. When trust erodes, control becomes the primary objective. In a system that is being handed over, flexibility matters more than yield. Short-term instruments are preferred over long-term commitments. Liquidity is quarantined rather than deployed freely. Speed of execution replaces certainty of outcome. Institutions are preparing to operate efficiently in a world where traditional mechanisms no longer respond. History offers clear lessons. In every major transition, gold standard, Bretton Woods, fiat currency dominance, the public experiences the change last. First, anomalies appear that are inexplicable by conventional wisdom. Second, institutions implement quiet adjustments. Third, a reframing event arrives, and suddenly the new system feels inevitable. The rules are no longer optional. The narrative has shifted. The public has already fallen behind. This is why headlines matter less than positioning. News stories capture symptoms. Institutions act on signals invisible to most observers. Long-term commitments shrink. Short-term instruments multiply. Flexibility is valued over yield. That is the language of adaptation in a shifting system. It is not optimism, it is preparedness. The monetary shift is not about inflation, interest rates, or asset prices. Those are distractions. The real transformation occurs in the mechanics, the plumbing, of money itself. Settlement cycles are shortened. Counterparty risk is isolated. Cross-border liquidity is ring-fenced. Temporary fixes become permanent rules. Emergency facilities quietly become standard operations. This is not about patching leaks. This is about constructing a new vessel to replace the old one while the old one is still afloat. If you want to survive or even thrive in this environment, the lesson is simple. Watch the anomalies, not the headlines. Track the quiet adjustments, not the press releases. Understand the subtle signals of a system being rewired. Shifts in liquidity flows, unexpected asset behavior, new rules quietly embedded in operations. Recognize that what appears as volatility is often preparation, not panic. Every monetary transition in history follows this arc. Anomalies first, silent adjustments second, public reframing third. None arrived with sirens, none with warnings, and none of them allowed for optional participation. The new system doesn't announce itself, it seeps in. By the time it is visible, the game has already changed. This is not a story of collapse. Collapse screams, destroys, and panics. This is a story of handover, a strategic, quiet, inevitable transition that has already begun. By the time certainty returns, it won't be about what changed. It will be about who noticed early enough to understand the shift was never a question of if, only when. And that is the real story today. The question isn't, if the old system will fail, as how far it has already been replaced. The liquidity operations you don't hear about, the emergency rules that quietly become permanent, the short-term instruments multiplying while long-term commitments shrink, the isolation of risk, the ring-fencing of cross-border capital. This is the invisible machinery of transition. Those who are paying attention can see the pattern. Those who are not will be surprised when the narrative finally changes, when the new system feels inevitable. The public experiences these shifts last. They always have. They always will. The shift is quiet. It is deliberate. It is inevitable, and it has already begun. The real question is, will you notice before it's too late?